Hello and welcome. You're watching KYC and I'm joined by Puneet Javeri today, and we're going to take a look at one of the IT names, Hexaware Technologies. Interesting because it's just IPO'd, right, in February of this year, Puneet, and it's private equity owned. And generally, when it's private equity owned, they're here to create value. That's the perception. So let's try and get straight to it. Let's see if they're actually here to create value and what the risks are like. What is it that we'd like to look out for when it comes to a Hexaware? One is they have a high exposure to quasi-US government agencies, and a lot of those are under the DOGE program, because of which there will be either some push with regard to spend timing. So the timing of the spend may actually get pushed, which could well impact the numbers for Hexaware. Or you could see a squeeze with regard to spending altogether, which could impact the numbers for Hexaware. And that changes substantially in the 3 months and therefore warrants conversation. The second piece is with regard to impact of tariff delays in spending. Now, this likely has already been impacting IT companies this quarter, as well as in terms of commentary. Also, the fact that that will impact what the Fed does in terms of rate cuts, and if that doesn't happen, will discretionary spend get impacted and will impact Hexaware Technologies in that sense. The third piece is with regard to slowdown in deal wins. We're already seeing that this quarter. There has been some bit of pessimism on this, and of course, this is just an extension of my previous point. And the last one is the possibility of margin expansion. This could well be an upside trigger than a downside. Yep. But there is potential there with regard to margin expansion. Is that a possibility or not is something that we'll want to explore. And any of these could well impact the stock as well as the way in which one sees the business going forward. But with that, let's look at the business itself. What exactly does Hexaware do? It aids customers in their digital transformation. It embeds AI into every aspect of service that they provide. And we'll talk a little bit about their AI solutions as well. I've kind of listed down some of the products that they have, and we'll come to that. They have a suite of platforms and tools which enable the customer to embed AI into their systems and software. They have partnerships with enterprises and solutions which help customers accelerate the time to market and improve developer productivity. So both of those, we can come to the next graphic, both of those could well impact. So one is convert ideas into applications rapidly. So that's one big plus. And that is RapidX. That is what RapidX does as a product. Tensai is AI-powered automation platform designed to help organizations automate IT and business processes. And Amaze is for cloud migration. So all of these AI actually help each cohort of service that they provide to their clients and help optimize it through AI. So positive. Now, in terms of what their service offering offers and what kind of customers they deal with, that's the broad-based brush. And along with it is travel and tourism as well, and transportation as well, which they are well placed to serve in terms of their delivery and product. Last off, service delivery. How do they actually deliver service? They have 39 delivery centers. They have 16 offices in America, across Americas, Europe and APAC. And they have around 32,500 employees in 28 countries. So that's broadly the presence that they have, very much a global presence. As I did mention, they're Carlyle owned, and therefore no worries with regard to capital, even pre-listing. Carlyle has just sold some of its stake. But Puneet, you want to talk and kind of give us the split with regard to how segmental performance has been?
I think you did highlight the segmental performance. The only reason, and one of the key reasons, and actually this is not a complete graphic, because the company, while in terms of, for IT companies, they give BFSI as a total. This one doesn't. They have a split between that. So financial services definitely is one of the largest contributors. But healthcare also includes the insurance vertical. And that's something new for this company. It's not compared to the traditional IT players where they have BFSI combined, and that's roughly 50-60%. They actually give a split of that. The third vertical is manufacturing. This also includes the consumer vertical, which is essentially retail for all other companies. And finally, the last three verticals, high tech and professional services is one. And banking is separately another vertical that they have.
So
this has been
so it's
fastest growing.
58%, sorry to interrupt, but it's 58% banking, financial services,
and
insurance.
similar.
That's broadly.
The key aspect is that insurance is linked with a slow growing sector of healthcare, which is affected because of Dodge funding, as well as we spoke about. And that is one key aspect. It's not the traditional IT play. Banking share has been lower versus other US consumers, and while this will be the highest growing vertical is what the management says. And finally, in terms of travel as well as transportation, another segment that's growing, but this year is expected to be slow. So that's what I wanted to highlight, a very differential segmental performance versus the peers.
Very interesting. Okay, so that's all about the business, and we hope that kind of gives you a good flavor as to what it does. But let's quickly move on to factors, because we'll try and break this down, and as always give you a KYC rating at the end of the breakdown that we'll do. That's how it all stacks up: income statement, balance sheet, cash flow and return ratios. Those are 4 of the parameters. Then we look at shareholding, street cred, very limited in that sense. Street coverage also limited, but we'll talk about it. And then Puneet hopefully gives us better perspective on the valuation to help us decide whether it's a good time to buy or not, or what kind of valuation to wait for, if at all that's the case. Let's look at the income statement, Puneet. Why don't you start with that?
Well, definitely. It's a company that's recently listed again, but definitely the 3-year CAGR of the company has been growing at a 19%. That's a good rate in terms of growth. In September 2020, where the company delisted from the stock exchange, we had the transaction then come up in the next 8 to 12 months in that time itself. And then we've seen the last 3 years very strong for the company in terms of revenue. EBIT margins of the company has been at around 13 to 14%. That's largely in line with its mid-cap players as well. And profits have grown at a 16% CAGR for calendar year 24. And that's another thing. The company follows a January to December calendar timeframe in terms of financial performance. That between January to December 2024, the PAT was at 1174 crores. That's grown at a 16% CAGR over the last 3 years. So definitely we've given this a thumbs up. Strong performance over the last 3 years, and expecting it to continue in this year as well, Harsh.
Very interesting. So that's with regard to top line. While top line growth is good, Puneet, PAT is just 16% versus the EBIT growth of 20%. Would you reckon that there is some item which has seen a bit of a spike, which is why you're not seeing the 20% growth on PAT?
So there are two things. One is the higher employee expenses, which has of course been recalibrated after acquisition. The second, you highlighted the AI part. That has led to investments by the company over the last 3 years. For TCS, just for example, they are investing 5,500 crores again this year. Last year also was similar, and that was double from FY23. So they have been investing in line with industry towards AI and incorporating that already with the current services they provide.
So interesting. So that's where the company is putting in money and investing. And some of that will come up in the cash flow as well. But let's talk a little bit first about the balance sheet of the company. It's a clean balance sheet, as is the case generally with IT. There's equity shareholders funds roughly sits at around 5,700 odd crore. And when you're looking at the market cap of the company, it's around 43,000 crores. So in that sense, the price to book is steep. But look at the cash bank balances, around 2,000 crore of cash bank balance. There's a slight increase with regard to debt. There's a slight increase. It's around 500 to 600 crore, but nothing significant yet with regard to where the debt is concerned. And that debt is not even significantly impacting, frankly, the P&L account. The interest cost is super low. So a clear thumbs up with regard to that. And that's what you would expect from an IT company as well.
Yes, definitely. Just some expenses in P&L like we spoke about, and cash flow as well. Essentially very clean. A 16% CAGR seeing over the last 3 years, 1,500 crores for calendar year 24. They will be looking to build on this in this year as well. And the net cash flow essentially, and that's largely because the cash flow from investment has seen an outflow of 600 crores. That's from investment that we were talking about. So they have been building on the investment side. CFO has been okay. So largely another big thumbs up again.
Yeah, I think last couple of years, it's reflecting in the numbers that the cash flow from investing activity has actually gone up. It's maybe 800 odd crore negative in the last couple of years itself. So maybe some bit of drag with regard to that on the net cash flow that we are seeing. Now, let's quickly look at return ratios, because that's the other piece. Where is it that the company is expecting, or what is it that it's expecting in terms of return ratios on the investments it's making? Again, fairly healthy overall. You're seeing 23.5% ROE in FY25. And ROC also fairly healthy, largely on the same number, in around the same number. So clear thumbs up. Please keep in mind that some of these ROE, ROC numbers improve very dramatically when it comes to IT companies, because you have, in comparison, a very low amount of investment that goes into the platforms and the businesses that they build. But you have recurring revenue which keeps coming in year after year, and you have new clients which keep utilizing the same services and the same platforms, and therefore your ROCE goes up. For example, a TCS has an ROCE significantly north of 40, ROE significantly north of 40, and therefore this has further legs to move up, and move up quickly if growth were to kick through. Right, Puneet?
Yes, definitely. And that's reflected in the ROEs as well, as you rightly mentioned. Strong ROE numbers in this particular year as well. But Harsh, what's largely been the shareholding like?
This is an interesting one. So delisting happened, and I'll take you through that journey a little bit. There was, in 2020, there was delisting which happened. Hexaware delisted from exchanges. Baring Private Equity took over and bought Hexaware. Thereafter, we had Carlyle buy Hexaware from Baring Private Equity, and currently Carlyle continues to hold around a 75% stake in Hexaware Technologies. So Carlyle is currently the promoter of Hexaware, and Carlyle is what has helped Hexaware list as well, again on exchanges. Likely they have a pipeline to monetize the asset, but that's how the shareholding is playing out. Clearly a strong promoter in Carlyle. It's not an individual promoter or a promoter entity or a promoter group, and that kind of gives Hexaware that level of independence to operate, and gives it also the push and the recognition required to go global in a big fashion. So both of those are positive when it comes to how one looks at the shareholding.
Definitely, and the street coverage and the street cred, here's a little tricky part. I'll just take the street coverage first. There's three analysts, JP Morgan, JM Financial and Axis Securities have coverage. They are anticipating, if we can move on to the next graphic, they are anticipating, and all three have buy calls, of course. They are looking at a return potential of 22%. So that's definitely a positive. The only reason we've given it a neutral rating essentially is because of the limited analyst coverage, but the company has essentially, in terms of, it's just been a very recent listing, just a couple of quarters in terms of results. So definitely a neutral is what we're giving. And also, the JP Morgan was also the banker for the IPO. So they have coverage. That's something that we see as a trend as well. But Harsh, overall, street cred, what do you make of it?
Yeah, so again, not looking very pretty from a perspective that, one, you already have a large private equity investor who has divested from the company in a big fashion. Again, I'll take you through that journey. September 2020, they delisted, their plans materialized, Baring took over. Thereafter, you had relisting, which happened on the 19th of February 2025. In around the price at which it's trading right now. So it's trading at around 700 rupees a share. That was the IPO price as well. The IPO opened at a slight bit of premium. So at 760 odd rupees is the IPO open. So return since listing, the stock is down around 7 to 8%. But so therefore very muted returns on listing and very muted returns even on IPO. And this is from February to now. When you have seen a reasonable amount of returns that we've seen, even generally from markets, given that we bottomed somewhere at the end of February and March, we started to see a bit of an uptick. Of course, April was the major one, but we've not seen that from a Hexaware yet. So no IPO returns per se for investors. Not much money left on the table is generally how one would look at it. If one were to look at the kind of returns that we've seen. but valuations, Puneet.
Yeah, and valuations here, this we put a list of a few companies, and while this is not comprehensive, we've largely compared it with the listed mid-cap players, and how does it fare with someone like the largest player, which is TCS. Currently, valuations at 26 times price to earnings, while not very on that front it looks expensive compared to its large cap players, but growth also higher than the company. And when you compare with the other players like Persistent, which is at 48 times price to earning, they are also anticipating a good year over the next couple of years. That's one. We've also added a couple of other players, Coforge, which is another big one in terms of a top mid-cap company in the IT space. That's one, trading at 35 times price to earnings. And finally, in terms of LTIM as well. Now, LTIM, again, an IT services company. We have LTTS, which is L&T Technologies, is a more of a product company. So hence, we've compared it with LTIM, largely trading in the 26 to 27 times price to earnings, but definitely cheaper to the two biggest mid-cap companies, which are very well known, both Coforge and Persistent, but not too far away in terms of comparing with the large cap IT players as well.
So neutral and fair call on that. One more thing that one needs to note is whether money was actually raised in the IPO or not and actually put to use by the company, and that's not happened. Something I just want to quickly flag off and clarify, because if it's an OFS, it means that the existing holder, which is Carlyle, has actually sold in the IPO. And that's something that you may want to bear in mind while you're making a decision on this company. Let's see how the rating stacks up actually as a result of all of this. You have 4 thumbs ups to start off. Clearly, growth is decent on the income side of things. Balance sheet is clean, no doubt. Cash flow largely following the profit after tax. 16% growth on PAT, 16% growth on cash flow from operations. Return ratios also were fairly decent, 20% plus, with scope for upside. We spoke about that. Shareholding is the other piece where you have 75% held by Carlyle, so thumbs up there. Street cred, nothing much left for investors, frankly, at least on IPO debut to now. You've not seen any returns for investors. Street coverage was a neutral, and valuations are neutral because street coverage is low and valuations are largely in line with their larger cap peers and slightly at a discount to some of the medium-sized IT players. 6 out of 8 is what Hexaware Tech gets on our KYC rating. Now, in terms of outlook, Puneet, why don't you take us through what the company has guided for and what to expect therefore?
Definitely, and this will be very quick because we spoke to the management as well on very detailed in terms of outlook, and the reason why I wanted to highlight is that the company actually has given a very detailed outlook in terms of both revenue and EBITDA. So if we can show that graphic as well, because in terms of revenue, they are anticipating in terms of Q2 to be moderate, but the Q3 is expected to be decent. This is again calendar year, so Q2 will be April to June, and post that will be Q3. They are expecting strong Q3 as well as Q4 for the company in terms of EBITDA as well. Very quickly, if I can highlight, they mentioned that in terms of EBITDA margin, this is EBITDA. We don't generally see it, but they've given the guidance on EBITDA specifically. That is expected to be between 17.1 to 17.4% range. They're currently at 16.7, so not very far off. And essentially, I asked the management on this, and they've said that they will be starting to invest in terms of growth going forward as well. But largely, very positive guidance, Harsh, overall as well.
Okay, so positive guidance overall, but let's quickly hear it from the management themselves. We spoke with the management of Hexaware. Here's a slice of that conversation.
I'll say at a broadest level, it is a surprisingly normal quarter for us, right? Notwithstanding all the uncertainty that is happening, it was a normal quarter for us. Like you said, the revenue profile was as expected. We actually improved our margins. But the best thing that happened was we won a number of deals that positions us really strongly for the remaining quarters in the year. We also added quite a bit to our large deal pipeline. So between the two, there's just a lot of confidence about the future for us.
And is there any kind of, essentially any cancellation or project delays that you see in March? Or as you rightly mentioned, it was just a normal quarter, so you didn't see any of that post, the President Trump swearing in February. Nothing as of that sort in March. Would that be a safe assumption to make?
Well, I'll say actually we had two. that, one happened at the end of quarter one actually happened through in early part of two, but since it's material, we already spoke about it. In spite of that, we will have a good quarter two. Now, without that, we would have had a great quarter two, but in spite of that, we will have a decent quarter two. And actually, those quarter-on-quarter headwinds will go away in quarter three. So actually, quarter three will accelerate growth.
Now, just wanted to get into the segmental performance of the company. You have separately financial services, you have insurance, which is with healthcare, as well as banking as a separate segment. Just wanted to start off, essentially with first with how are you viewing these segments, because we are expecting most IT companies to do well in BFSI. In terms of banking, was there any kind of one-off in this particular quarter, and how are you viewing the current conversation with the client on the ground? Because a lot of subcontracting costs have slightly inched up, while a lot of companies are also insourcing it now. We saw one of the biggest US banks come out with that in this particular quarter. So if you could start us off with banking first, and how are you viewing that segment currently for Hexaware Technologies?
So we operate on a calendar year basis. By end of this calendar year, banking will be at a point where we are banking is outgrowing company average on growth. Now, this is in spite of having, like you said, a negative start. Now, the negative start is a consequence of a number of projects and programs that ended, but we have a fairly large number of deal wins here, and we have a large pipeline. So even as early as quarter two, you will see a very sharp turnaround. We may actually end up having double-digit quarter-on-quarter growth for the banking sector. By end of the year, we will certainly be at a point where we are growing better than company average. That's in banking. Now, you mentioned earlier that a lot of companies in our sector are expected to do well in banking and financial services. That is correct, because these industries are not first-order impact from tariffs. And actually, between banking, financial services, and insurance is a part of another vertical, it's well in excess of 50% of our revenue. So, and these are not industries that are directly impacted by tariffs.
And, sir, I just want to take the point forward. As you mentioned, it's not banking as well as BFSI essentially not seeing first order effect, but we've seen a lot of essentially some effect on the healthcare vertical for the IT space as a whole. We've seen some cuts for research organizations in the US because of DOGE, and those were essentially funding a lot of IT spends, at least for the mid-tier IT companies. I want to understand your outlook for it, because you also have the insurance vertical that, and as you rightly said, healthcare and insurance is roughly 20%. Banking being at 8% could grow faster, and that's a very positive outlook coming from you. But for healthcare and insurance, if you can just give us some separate commentary for the two. Seeing some pressure in healthcare because that's been something that's been echoed around, and insurance as well because the costs have gone up materially. How are you viewing these two segments, at least for this year? And I know it's a very uncertain environment, so in terms of guidance, you don't give guidance, but currently on the ground, what are you seeing and what do you expect for the next couple of quarters at least?
So first is at an aggregate level between those two segments that we report together, we actually expect that we will have a decent performance for the year. It won't be a driver of growth, as in it won't outgrow the company, but it'll grow at roughly at company average. Now, between the two, I think insurance will do better for the reasons you mentioned. Now, we don't have kind of work directly from agencies that get funding, but we do have life sciences customers. There is a general downward kind of sentiment on vaccines and drug manufacturers. So I'll say kind of life sciences part of the healthcare part will do somewhat worse than what it could have otherwise. But in aggregate, like I said, we will actually still do company average performance for these two sectors. We announced a number of deal wins in quarter one. One of them was actually in the insurance sector and in an interesting segment with a company that is actually the world's largest pet insurance company. And that's an area of decent spend for customers, consumers in a lot of countries, and it's a growing segment in pet insurance. And we want to we become a strategic vendor for a pet insurance company in quarter 1.
And just one question last on the segmental side. Manufacturing, you have it with consumer, that's roughly 15% of your revenues. Again, a segment that's been rocked because of tariffs. Anything that you can quantify in terms of conversations, any kind of delays that you saw, or customers taking a little longer to plan out their IT spends for this year?
Definitely, yes. Unfortunately, it has already been kind of a segment that has not done as well as company average for us. But I think that weakness is going to continue. They're definitely kind of first order impacted. Fortunately for us, it's only 15% of our revenues.
And so you've given a very detailed, in terms of not guidance, but outlook as you're calling it. And I just want to get into that a bit, because you said that quarter 2 you're expecting to deliver reasonable but not sharp growth, but quarter 3 will have accelerated growth. What's giving you the confidence as of now? Because it's still some time away for you, but 6 months down the line, in such an uncertain environment, what are you seeing currently? Is it the confidence of deal wins or something that you can tell us?
So 3 things I'll say. First, again, I want to reiterate, we operate on a calendar year. So quarter 3 for us begins from July. So it's not 6 months away. 2, we had we called out specific headwinds for Q2. Now, actually, but for those, Q2 would have actually been a very good quarter. It'll still be a good quarter. Okay? And those kind of quarter-on-quarter headwinds will go away. So that is going to kind of be additive to the growth from Q2 to Q3.
All right. So hope we've tried to, or rather we've tried our best to break this down as comprehensively as possible. Thanks so much for joining us, Puneet. And thank you, viewers, for staying with us. For now, it's a goodbye. Stay tuned. More action on the other side.